Euro to US dollar is sitting on a knife's edge at 1.1617, and there is a trap built into the price structure right now that will slaughter one entire side of this market. The EU Commission just warned that Eurozone growth is set to slow in 2026 because the Middle East conflict is fueling inflation. That is a stagflationary pulse straight into the Euro's heart. Yet on the 1-hour chart, the algorithm is screaming strong buy, while the daily chart screams strong sell. That divergence is the trap. There is one danger zone and one hidden opportunity today, and I'll show you both. Stay until the end. I'm giving out 3 exact entry and exit levels you can use right now. Let's get the instant market verdict. The session bias is fading rallies. We are looking to sell into intraday strength, not chase the 1-hour pop. The one invalidation level that proves this entire bearish structure wrong is 1.1681. Write this number down. If we break and close above 1.1681 on the 4-hour time frame, the whole structure shifts and we could see a rapid squeeze toward 1.1750. Until then, sellers control the cycle. I want you to type that number in the comments now. 1.1681. That is the line in the sand. Now let's zoom out and walk through the technical architecture, because most retail traders only look at the 15-minute chart and they miss the massive gravitational forces at work here. We start on the monthly. The monthly trend is still a strong buy, and that's what makes this so dangerous. The long-term trend is up, which means bearish moves can feel like traps that reverse violently. But drop down to the weekly, and the picture changes. The weekly is a sell. The daily is a strong sell. That's 2 higher time frame alignments against the euro. When the weekly and daily agree against the monthly acts as a distant target, not an imminent reversal. Price can continue falling while still being inside a larger uptrend. The daily strong sell is your operational bias. Now let's place the moving averages on that canvas. The 200-day moving average comes in at 1.1589. Basically coinciding with the key daily support at 1.1590. That's no accident. The 200-day is the institutional anchor. It is acting like a magnetic floor, but also like a brick wall that, if broken, turns into a trapdoor. Right now price is 1.1617, so we are only about 25 pips above that line. Look above price. The MA5 at 1.1632 is immediate overhead friction. The MA10 at 1.1651, then the MA20 at 1.1672, the MA50 at 1.1685, and the MA100 at 1.1683. Notice how the MA50 and MA100 are clustered right around 1.1685 to 1.1683, and that's exactly our invalidation zone. That's not a coincidence. That's market structure. The moving averages are building a descending ceiling, a wall of supply that will be hard to break unless a fundamental shock hits. Momentum confirms the bearish lean. RSI 14 on the daily is 42.36, still below 50, still in bearish territory, no hint of oversold bounce yet. The MACD on the standard 12/26 setting is printing negative, minus 0.001. It's not deeply negative, but it's below the signal line and below zero, which means no bullish divergence is forming. Buyers are exhausted. Every pop is being sold into. Here's what most traders miss. When you see a 1-hour strong buy signal inside a daily strong sell structure, that's not a trend change, that's a retracement offering a better entry. The 1-hour strong buy is bait for breakout traders. The 5-hour chart, by the way, is already a sell again, telling you the intraday momentum is failing. Now the support and resistance numbers you need tattooed on your screen. Key resistance levels. 1.1653 is the first, a prior swing high and the 50% retracement of the recent down leg. Above that, 1.1681 is the structure breaker. Key supports. 1.1590 is the immediate daily floor, fused with the 200-day moving average at 1.1589. Below that, the next liquidity pool sits at 1.15555. This is a prior weekly low and the next obvious target if the 200-day gives way. A close below 1.1590 would open a straight shot into that 1.1555 zone. Before I give you the trade setups, I need to connect this technical picture to the fundamental driver and the cross-asset web, because no chart lives in isolation. The 24-hour news item is blunt. The EU Commission says Eurozone growth is set to slow in 2026 as the Middle East conflict fuels inflation. That is a double hit. Slower growth means the ECB stays cautious, potentially lagging behind other central banks, while inflation from geopolitical shocks complicates the rate path. That combination is a euro negative. And the analysis article floating around the desks today says it plainly. The euro to US dollar breakdown shows the US dollar still controls the FX cycle. The dollar is the king, and the euro is the vassal right now. Now connect the cross-asset dots. Look at cable. Look at pound sterling to US dollar. It's also under pressure, testing its own structural supports. That tells you this is not just a euro weakness story. It's a broad dollar bid. But the policy divergence is what makes the euro the weaker of the dollar killers. The ECB is staring at growth fears. The Bank of England is still wrestling with services inflation, so sterling is holding marginally better on some crosses. That differential is pushing euro to pound sterling lower, which feeds back into euro to US dollar selling pressure. Meanwhile, gold is bid, and oil is bid on that same Middle East conflict headline. But historically, a commodity bid on geopolitical fear does not equal a euro bid. It often means risk-off and a flight into the dollar. The fear architect in gold is screaming inflation and uncertainty, but the dollar is getting the haven flow, not the euro. That's a critical cross-check. If gold is up and euro to US dollar is down, the dollar is winning the safe haven battle. That reinforces the sell bias. So the 1 to 2 week directional lean is bearish towards 1.1555. With an extension toward 1.1500 if the 200-day gives way cleanly. The exact event that would invalidate this thesis entirely is a weekly close above that 1.1685 area, or an explicit ECB hawkish pivot, neither of which is likely this week given the Commission's own warning. So the path of least resistance remains down. Now, most people will click away before this part, but this is where money is made. Keep watching. I'm about to lay out 3 specific trade strategies, each with exact price triggers, stop losses, targets, and the risk-reward logic. Use the chapters to jump back if you need, but do not skip. Strategy 1. This is the sniper, the conservative play. We are waiting for a rally into the resistance cluster to sell. The exact trigger condition is a move to 1.1653. But don't just slap a limit order there. Wait for a 1-hour bearish rejection wick or a 1-hour close below that level after testing it. That confirmation filters out the false breakouts. Entry on that rejection, sell at 1.1653. Your stop loss goes at 1.1685. Why there? That's above the MA50, MA100, and the daily structure invalidation. It gives you a 32 pip cushion. Target 1 is 1.1590. Right at the 200-day MA and the support floor. That's a 63 pip reward, roughly a 1 to 2 risk reward. Target 2 is 1.1555, adding another 35 pips for a total of about 98 pips, which is a 1 to 3 risk reward. If price approaches target 1 and then stalls, move your stop to break even. This setup is void if we get a 4-hour close above 1.1681. Respect that. Invalidation, strategy 2. This is the active trader play, for those who want to participate without waiting for a perfect retracement to 1.1653. You're fading the 1-hour strong by momentum as it exhausts. The entry condition is a pullback into the 1.1630 to 1.1640 zone. That zone contains the MA5 and MA10 dynamic resistance, and it's the natural area where intraday bulls run out of steam. Wait for the 1-hour MACD to roll over and print a bearish crossover. Enter at 1.1635. Your stop loss goes at 1.1665, just above the MA20, for a 30 pip risk. Target 1 is again 1.1590, that's 45 pips, a 1 to 1.5 ratio. Target 2 is 1.1560, just above the 1.1555 support, total 75 pips, 1 to 2.5. Once target 1 is hit, Trail the stop on the remaining position to your entry. This is a mean reversion trade inside the daily downtrend, and it has a higher probability of being filled than the sniper entry, but slightly less precision. Now here's an interaction moment. Let's see how aligned we are. Type your euro to US dollar range for tomorrow in the comments right now. Write something like 1.1590 to 1.1650. I read these, and it helps me gauge the community bias. Strategy 3. This is the aggressor, high risk, only for those who know how to lose small and manage risk aggressively. This is a momentum chase on a confirmed breakdown. The trigger is a 15-minute close below 1.1590. Once that prints, wait for a small retest of the broken one. 1590 level as new resistance. Enter short on that retest, so your entry is around 1.1585 to 1.1590. Stop loss at 1.1620, a tight 30 to 35 pip stop. Target 1 is 1.1555, the next support. Target 2 is 1.1520, an extension level. This trade captures the trapdoor momentum when the 200-day MA gives way and the stops resting below 1.1590 get triggered. But be warned, false breaks of the 200-day are common, and you will get stopped out if the market reverses. Position size must be small. If you don't have a plan for losing 3 in a row and still being fine, do not take this trade. Risk management pulse, 30 seconds of pure discipline. Never risk more than 1 to 2% of your account on any single trade. No positions through high-impact US or Eurozone news. Stops are non-negotiable. Set them immediately upon entry and never widen them to accommodate hope. Now let's pull it all together. The most critical level for the next session is 1.1590. That is the 200-day moving average and the support that holds the entire daily structure together. As long as price stays above it, the door remains open for a bounce back into the 1.1650 resistance. But a decisive break below it flips the script, and the next stop is 1.1555, potentially 1.1500 in the days that follow. That's the line you watch like a hawk, teasing tomorrow's focus. We have US durable goods orders and Fed speak on the calendar. Any upside surprise in US data will likely accelerate this dollar move and test 1.1590. I'll be here same time tomorrow breaking down what happened and what's next. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that risk asset shadow play is absolutely live right now with funding rates flipping. That video is up on the channel. Check the end screen right now and go straight into it, because the correlation fracture we are seeing is extremely tradable. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage across all 8 assets. I'll see you in the next one.